Hi guys, welcome back to my channel. Kelvin here. Selling options is a very good way to get consistent income. But sometimes the stock doesn't go the way you want and it goes in the money. When this happens, ho ho. But luckily, there's a way to protect your backside and avoid an assignment, and that is called rolling. I think it's a very important strategy that you will need to know if you want to level up your option selling game. So in this video, I will explain what is rolling, in what situations should you roll your options. Then, I will also show you a step-by-step guide on how to roll your options in interactive brokers. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a hamster running in a wheel. Alright, let's start right now. First thing first, what is rolling? Rolling is a defensive option strategy to protect your options trade. You will sometimes need it if the stock goes in the money and you want to avoid getting assigned on a put or getting exercised on a call. Basically, rolling is like this. You got a buyback option, you got a sell new option. You got a rolling strategy. Or in simple English, rolling just means that you buy back the option at a loss. Then now, because you are losing money, you sell a new option at a further expiry date to cover the loss. Let me show you an example. Let's say you sell an option on a stock. Let's call it broccoli stock. The stock price is now $100. You sell a put at $90 strike and you collect $5 premium. This will be the profit loss chart. Because you collected that $5 premium, the break-even is $90 minus 5 or 85. Then, as long as the stock stays above $90, you will whack small and you get to keep all that $5 premium. But let's say if the CEO comes out and says something stupid or some hedge funds decide to short the stock, then the stock will start to dip. When the stock goes below your $90 strike, your profit will become lesser and lesser. And if the stock goes below your $85 break-even, you will start to lose money. Let's say the stock is now at $80 and let's say you are too busy climbing rank in LOL and you didn't do anything. In the end, you will be assigned 100 broccoli stocks and will have an unrealized loss of $5 times 100 or $500. Here's where rolling comes in. Let's say you don't want to get assigned 100 broccoli stocks. You'll be like, I don't want. What you can do is roll the option and avoid getting assigned 100 stocks. Here's how to do it. First, you buy back the option. Maybe now the option has $7 premium. So you spend $700 to buy back. How much is your total loss? Let's see. At the start, you sell the option and receive $5 premium. So you earn $500. Then you spend $700 to buy back. Your total loss is $200. Next, you will need to sell a new option to cover your losses. To do this, you can choose an option that expires 4 weeks from now. The broccoli stock is now $80. So let's sell a new put option at $80. The premium is $4. So once you sell a new put option, you will immediately receive $400. Now let's see what's our final profit. Just now, our total loss is $200. When we sold a new option, we received $400. So our final profit is $200. So what just happened? Magic! Just kidding, a few things happened. First, we avoided assignment by lowering the strike price from $90 down to $80. Second, instead of having a $500 unrealized loss on our stock, we have a profit of $200. However, in exchange, we have a put option that expires 4 weeks later. One more thing, what's our new break-even price? Our break-even price is the new strike price, $80 minus the final profit, $2. So by rolling the option, our break-even price has gone from $85 just now down to $78. So now you roughly know how rolling works. Let's talk about the reasons for rolling. The first reason is you suddenly become bearish on the stock and you are not okay with getting assigned at a high strike price. Let's say, for example, you sold a $37 put option on AMC. Then, after selling, you found out that AMC is a bad stock. Immediately, the stock starts to dip. If you don't want to get assigned at $37, you can roll your option down to a lower strike price. That way, you don't have to buy AMC at $37. The second reason you will want to roll is when you don't want to get assigned at all. For example, I'm selling Tesla put options on margin to collect that sweet options premium. But I actually don't want to take assignment if I don't need to. In that case, if Tesla doesn't drop, I can keep selling puts to collect a premium. But if Tesla drops, I can just roll my strike down to avoid assignment. Take note that rolling also works on covered calls. To do that, it's the same thing. You buy back the call option at a loss, then you sell a new call option at a further expiry and a higher strike price. This is super useful if the stock suddenly shoots up and goes to the moon. For example, let's say Palantir is at $20 and you sold a call option at $21. The premium you get is 50 cents, so you earn $50. Then Palantir suddenly shoots up to $23. If you were to let the call option get exercised, the stock will be called away at $21. your final profit will be $100 capital gain and $50 premiums collected, total $150. But if you roll your call option to $23, you will be able to earn $200 capital gain on top of your $50 premiums collected. However, take note that you don't have to roll every time the stock reaches the option strike. It depends. If you are doing the real strategy, sometimes it's better to take assignment like a man or woman and start selling covered calls. Because even though rolling will help you reduce your losses, you are actually reducing the amount of money you can collect. If you can start selling covered calls, you'll be able to collect some fresh new money immediately. Second, it's actually possible to roll forever. Can, no problem. But take note that every time you roll, you're only collecting a bit of premium. So you have to see whether it's worth it or not. Sometimes it is better to take assignment so you can start selling covered call. Third, if you really want to roll, it is best to roll as soon as the stock goes past the break-even price. Because the deeper in the money the option is, the lower the extrinsic value your option will have. Just in case you do not know, option price has an intrinsic and extrinsic value. I won't go too deep into this, otherwise this video will be longer than 9 episodes of the Squid Game. If you want a full explanation, YouTube has a lot of 10-minute videos explaining about it. But here's a quick summary. Intrinsic value is the actual value of the option, while extrinsic value is affected by volatility and time to expiry. That's why when the option is nearing expiry, its value drops because extrinsic value decays. If you check deep in the money option, you'll see that it has a delta of near to 1. This means that the option price is mostly intrinsic value and has very little extrinsic value. So it becomes very hard to roll your options for profit. Let me show you a real example. If you see Tesla $1,000 put option that expires 16 days later, the delta is 0.99. The premium is $215.05. Now, if you check Tesla $1,000 put option that expires 44 days later, delta 0.944. The premium is $270.95. Even if you roll, you will only get an extra small $2 premium. Might as well don't roll. When this happens, it's much better to stop rolling and take assignment instead. So that was some tips about rolling your options. Now, I want to show you a quick step-by-step guide on how to roll your options. I'm using Interactive Brokers, but the steps are basically the same for any brokers out there. I will show you 2 ways to roll an option. I will start with the manual way first, where you buy back the options manually and sell new options manually. To do this, first you find the option that you want to buy back. Let's say I want to buy back this new option. So I tap on it. To buy back, I tap buy. Remember, you want to buy, don't go sell another new option. Here, for order type, you can either use limit order or market order. Personally, I prefer market order because I want to buy back immediately. But if you want to use limit order, I have a pro tip for you. On the right side, you will see an arrow. Tap on it. Here at the bottom, you can see ask price and bid price. But you also have mid price, which is the price in the middle of bid and ask. Some people recommend buying back at the mid price. But it really depends on yourself, No right, no wrong. Once you are done, just submit your buy order. Okay, the next step is to sell a new option so that you can cover your losses. To do that, you can sell a new option that expires about 30 days later, but at the lower strike price. Tap order, change it to sell order, then sell the option as you normally would. And tada, you have successfully rolled your options. Now, I will show you the second way. It is actually much faster. If you are using Interactive Brokers app, on the left side, you can find option exercise roll. Tap on it, tap on the option that you want to roll, tap roll. Here it says you need to select the option you wish to roll. Find a further expiry date, choose your option strike price, then roll option. Here you can see that you will buy back the old option, then sell a new option. Same thing here, you can use either limit order or market order. The limit order is just the final profit that you want to get. If you are not sure, just tap the down arrow, then choose mid. Here, you can see that you will receive a credit. If you tap the calculator, you can preview the amount that you will receive and what is the estimated commission. Okay, if everything is alright, just submit and tada, you have rolled successfully. So that was a quick tutorial on how to roll your options. Hopefully, you find it useful. If you have any questions, just let me know down in the comments below and I will try to answer them. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.